Amrutanjan Health Care has spent 129 years building one of the most recognized brand names in Indian consumer goods. Its financial foundation appears stable, zero debt on the balance sheet, and a return on capital employed exceeding 21%. Yet a 47% year-over-year drop in quarterly profit, following an anonymous whistleblower complaint against senior management, has brought the stock to a critical juncture. To understand the implications for investors, we have to examine the architecture of their core business model. The foundation of the company is its pain and congestion management portfolio. This is their traditional Ayurvedic moat, built on decades of consumer trust in their signature balms and roll-ons. This tree map breaks down how they've diversified to protect that moat. Beyond pain relief, they rely on two additional revenue pillars: a beverages segment focused on hydration drinks, and a women's hygiene division centered around their Comfy brand sanitary napkins. They operate within the Indian fast-moving consumer goods sector, the fourth largest sector in the domestic economy. Despite their flagship product existing for over a century, this bar chart reveals that household balm penetration in India remains at only 37.5%. That leaves substantial headroom for scalability. In the FMCG space, scalability requires physical reach. A company's distribution network effectively serves as its order book. Amrutanjan maintains a decentralized network of over 1,600 distributors, supplying 1.1 million retail outlets. This structure minimizes customer concentration risk. No single buyer controls a significant portion of their revenue. A historic brand moat and a million-outlet distribution network provide structural resilience. However, this same rigid structure makes the company vulnerable to sudden internal shocks. With a market capitalization of 1,543 crore rupees and a stock price trading near 533 rupees, the market is currently pricing in significant uncertainty. Institutional investors typically evaluate this by building a discounted cash flow model to estimate the intrinsic value of the business based on its future earning power. The current trailing price-to-earnings ratio sits at 26.47, but for an asset-light FMCG company, evaluating the enterprise value to EBITDA ratio provides a clearer comparison of operational pricing. When we pivot to the June 2026 quarter results, the pricing logic shifts. The PEG ratio, measuring price and earnings against growth, has fallen to a negative 27.9. Top-line sales numbers were positive. Quarterly operating revenue grew 8.4% year-over-year, hitting 107 crore rupees. Look at this diverging chart. While the top-line revenue ticks upward, the net profit line dropped 47.5% year-over-year, coming in at just 4.4 crore rupees. This divergence between growing sales and shrinking profits indicates pressure on their EBITDA margins. Top-line growth is a mirage if margin compression is destroying the short-term earnings per share. To contextualize that earnings contraction, we have to measure it against the company's historical capital allocation. Historically, the company has maintained a return on capital employed of 21.44%. This scale visualizes their financial leverage. They achieve a 15.6% return on equity while maintaining a debt-to-equity ratio of exactly 0. The balance sheet is supported by 326 crore rupees of net worth. The test of a company's financial health is the CFO to PAT ratio. It measures whether the reported profit after tax actually exists as liquid cash, or if it is trapped in uncollected receivables. As this funnel demonstrates, Amrutanjan's cash conversion is high. For the fiscal year ending 2025, they reported a PAT of 50.83 crores and generated 50.90 crores in net cash from operations. Free cash flow remains positive. However, given the recent margin compression, the working capital cycles, specifically inventory turnover and debtor days, require close monitoring in upcoming quarters. Because the underlying cash engine functions, the recent profit drop is strictly an operational cost issue, not a failure to collect cash from the market. Quantitative metrics can be overridden by a qualitative governance discount. When investors lose faith in the people reporting the numbers lose their premium. For Amrutanjan, the trigger for this discount was a regulatory filing submitted to the stock exchanges on February 14, 2023. In this mandatory disclosure letter, the company formally acknowledged receiving an anonymous whistleblower complaint directed at senior management. The letter outlines allegations including ethical concerns, conflicts of interest, and specific claims of undue enrichment through marketing, advertising, and procurement activities. In response, the board initiated a forensic investigation, bringing in Deloitte Touche Tohmatsu to audit the company's financial operations. To verify the health of a company under a governance cloud, we can track the 5-year growth trend of statutory auditor fees. This dual-axis chart illustrates the theory. If auditor fees begin to spike disproportionately compared to standard revenue or profit growth, it signals increased audit complexity and a requirement for further investigation by shareholders. We also look closely at shareholding patterns during these events to measure how institutional capital reacts. Currently, the combined holdings of foreign and domestic institutional investors sit at roughly 14.7%, indicating a cautious institutional presence. Promoter pledging remains absent at 0%, providing a baseline level of stability at the top. But the market reality is strict. Even a zero-debt, cash-rich business with a century-old moat becomes a high-risk proposition for major funds until a third-party forensic audit officially clears the management. To price this specific mix of risk and legacy, we have to look at the broader market context and compare Amrutanjan against equivalent FMCG and pharmaceutical peers, like Imami or Zandu. This matrix filters the competitive landscape. At a price-to-book of roughly 4.1, we can gauge the premium the market is willing to pay for its net assets relative to its competitors. By keeping the focus on the industry PE average, we can isolate whether the stock's current price accurately discounts its recent operational struggles. We then pivot to technical chart analysis to gauge how market sentiment is pricing in these uncertainties today. Over the trailing 52 weeks, the stock has traded between a high of 790 rupees and 95 paise and a floor of 486 rupees. The Relative Strength Index, or RSI, sits at 49.89. This places the stock in the center of a neutral trading zone, neither oversold nor overbought. With momentum stalled, technical traders rely on daily moving averages to identify the next probable price action. This chart highlights the setup. Investors must watch the interaction between the 20, 50, and 150-day moving averages. A tight convergence of these lines often precedes either a breakout or a technical breakdown. Ultimately, every piece of analysis serves one question. Can this asset realistically deliver a 15% compound annual growth rate over the next 5 years? The bull case relies on the fundamentals, a debt-free business with a 129-year distribution legacy and a functioning cash conversion engine. The bear case points to the immediate reality. Quarterly profits have dropped significantly, margins are under pressure, and the forensic audit remains unresolved. Under these conditions, a hold or avoid strategy remains the most prudent path. The true value of the business cannot be securely calculated until the forensic audit clears the management, and operating margins prove they can expand once again.